Janet Yellen back at the helm.
We do think there will be inflation in prices in 2021, but probably more so in asset prices. Seeing a lot of pieces of a mosaic that would allow one to say we might be in a bubble. There is no justification for GameStop to be trading at these levels.
Let's take a look back at January and markets and give us the perspectives on performance.
Yeah, January was a bit of a volatile month, a lot going on for markets to digest. When the numbers were tallied up, the month of January slightly negative for the S&P 500, with most of those losses occurring in the back half of the month. US small caps were the big winner, up over 5%. The majority of those gains happening during the first couple weeks of the month. Foreign equities, a bit of a mixed bag, and interest rates generally moved higher, particularly during those first couple weeks of the month. So it was definitely a tale of two halves. First half of the month was all about more fiscal stimulus. It was about Joe Biden unveiling his $1.9 trillion COVID relief package. It was about Janet Yellen testifying in front of Congress before later being confirmed as Treasury Secretary, and sort of being all in on needing to provide more relief, more fiscal stimulus, particularly while interest rates are low. And so that was the story during the first half, and that created a lot of talk about bubbles. That obviously led for a more volatile second half of the month.
It feels like the inauguration was ages ago. I mean, we had sort of a new administration come in. We've had Senate runoffs. We've had all sorts of great political things. We've had all sorts of great economic and fiscal things happening. We've also had some interesting marketing things happening. But let's first talk about the great things that have been happening with the vaccines itself.
Yeah, a decent amount of good news around the virus and the vaccine, at least here in the US during the month of January. The first thing you'll notice is just if you were to chart the 7-day moving average of case counts in the US, they have started to fall here in January, which is very encouraging. And, deaths certainly haven't started to decline materially yet, but there is a lag. So the hope is that, absent any of this vaccine news, that the virus situation, maybe we've seen a peak in cases at the end of December. So that's the first note on the positive side of the ledger. Additionally, vaccine rollout is definitely going. It's going slower in some areas, faster in other areas. It seems as though generally the vaccine distribution and administration has been slower than necessary, certainly slower than a lot of folks would be happy with. But we are making progress. We're making progress on getting the most at-risk portion of the population vaccinated. So that's been somewhat encouraging. And some more potential positive news on the vaccine front with the Johnson & Johnson test results coming through and showing with a single dose, their test suggests you can prevent 100% of COVID deaths. So that's all on the positive side. The negative side, there have definitely been some hiccups in the distribution and the administration, the administering of those vaccines, and then also some somewhat scary news on different variants across the world, specifically the UK variant of the virus and the South African variant of the virus. And the vaccine showing to be far less effective against those variants. So that was the news on the negative side of the ledger.
What we've been researching, the rollout itself, while it seems to be going well, I think globally it's not going quite as fast. But here in the US, it's better than we expect, but still slower than we probably expect. And hopefully, by the end of the year, I think is when we would feel super comfortable that a large majority of the population would be vaccinated. Is that sort of what we're looking at?
Yeah, we've done a tremendous amount of analysis and work on the pace of vaccinations, and when we get to the point where we can break the link in the US between cases and virus outcomes, explicitly hospitalizations and deaths, we think we should approach that somewhere mid-springtime. And then we work on getting towards herd immunity, which that's a much taller order. That'll probably take later, much later in the year, if we even get there this year. So that's the general timeline, but still, even though the market action in the last couple weeks of January would suggest that seems very, very far away, all of the vaccination numbers, as you suggested, Will, all the vaccination numbers and the progress suggest we are still moving on that timeline. So we still feel pretty confident in those estimates. Somewhere around springtime, we break the link, and then somewhere in the fall, later in the year, hopefully we approach herd immunity.
So the reopening trade, the reopening ideas, the economic progress there is still on path to what we've originally sort of forecasted in our outlook. And maybe just quickly comment on the fiscal stimulus package that's been proposed that would sort of go parallel with that outlook.
Yeah, the big news right around the inauguration was President Joe Biden unveiling the 1.9 trillion COVID relief bill. And a bit of cold water was splashed on that idea during Janet Yellen's testimony. A lot of Senate Republicans in particular sort of balking at the price tag of this and talking about, how effective are a lot of these economic impact payments in the package going to be. So it seems like at this point, getting bipartisan support for a 1.9 trillion COVID relief bill seems very difficult. It seems like it could be a big hill to climb. And so for that reason, it looks more and more likely that this bill is either going to be compromised down, split into multiple parts, or if the Democrats decide they want to sort of go it alone, then they would have to go through the budget reconciliation process, which would take far longer than if they were to get bipartisan support. So for all those reasons, once again, the signal is still strong that there will be more stimulus, but there was definitely more noise in that it's not maybe going to happen as quickly as people expect and not going to be as bipartisan as maybe some people expected.
All right. And so Janet Yellen back at the helm. So that's a familiar name back into the powers of monetary and fiscal management here. Talk to the viewers about what our thoughts are on her appointment.
Yeah, we think right now having a former Fed chair leading the Treasury is more important than ever. And Janet Yellen is known as being very dovish, and all of the comments she made during her testimony for her confirmation hearings were all very, very dovish on the dovish side of things. So we put out in our outlook that the Fed's new role is debt monetization and market stability are the two primary roles the Fed is going to be serving. And it seems like Janet Yellen is going to be able to coordinate very easily with Fed Chair Jerome Powell to make sure that the Treasury's debt gets rolled over at a very low interest rate. So it's never been more important because fiscal stimulus plays such a role and there's so much debt from the U.S. government. It's never been more important that you have coordination between the Treasury and the Fed. And we think Janet Yellen is really the best candidate out there to coordinate on that level. So we think that definitely supports our outlook. One of our taglines was "No Hawks Left on Capitol Hill," and this certainly is in that direction.
Yeah, exactly. And let's turn our attention to some emerging narratives that we're seeing that we're showing green sprouts last year, and now they're really starting to take shape. So the first one is the emerging narrative of higher bond yields and higher inflation as we move into 2021 and beyond. So tackle that one first.
Yeah, when Biden's stimulus package relief bill was proposed, you did see a spike in yields. Now that needs to be put in context. So the 10-year Treasury spiked to 1.15%. So nothing to get extremely excited about. The 30-year spiked to 1.88%. Still nothing to get very excited about. Those are still very, very low yields. And the idea is that the year-over-year comparison for consumer prices is going to be so easy to beat that you could see a spike in consumer prices or consumer price inflation as we get mid-year. And that is basically already baked into the bond market. So there's definitely a narrative that you're going to see some type of an inflation spike sometime mid-year as the economic recovery progresses and as those year-over-year comparisons of consumer prices become very easy to beat. But once again, everything that Jerome Powell has said, everything that Janet Yellen has said, is that the Fed in particular is going to look through that spike in inflation, not adjust monetary policy, not even thinking about raising rates, and probably not going to slow the pace of the balance sheet expansion. So we do think there will be inflation in prices in 2021, but probably more so in asset prices than consumer goods prices.
Let's turn our attention to another emerging narrative, sort of the bubble mania. I mean, there's another emerging narrative that we'll tackle in a minute about what's happening with GameStop and some other of these AMC and stocks, but just the bubble narrative and what we're seeing in terms of how behavior changes near market tops.
Yeah. Seeing a lot of signs or sort of pieces of a mosaic that would allow one to say, hey, we might be in a bubble. The rapid adoption and new issuance of SPACs, special purpose acquisition companies, there were roughly 5 new SPACs launched per business day in January.
Explain to the viewers what a SPAC is, how it operates, and what the upside risks might be and the downside risks.
A SPAC is a special purpose acquisition company. This is a structure that's been around for a very long time. Basically what it is, it's also called a blank check company. And what you get is some type of a skilled or experienced manager, whether they were in private equity, hedge funds. They raise capital from investors, and they are going to take that money and they're going to merge with private companies to take them public. The thing is, when they raise the capital, they have not disclosed what companies they're going to take public, or if or when. And so, what ends up happening is we had a lot of blank check companies launched last year, and the speed of that really picked up this year. So there, on average, have been 5 new SPACs per business day in 2021.
And so if I was to invest in a SPAC, my understanding is they have to use their capital up within a certain period of time, or else they have to refund the money. That could lead to behavior where the SPAC is just saying, I've got to buy something. Yep. So what's the risk of them purchasing the wrong company?
Yeah, there are good deals and there are bad deals, just like a normal IPO type structure. And this is a classic case of too much money chasing too few assets. And what you're going to get are companies that in other environments probably would have never had the opportunity to go public, certainly not at the valuations they could now, and they are going to get financing. And some of those aren't going to work out.
Yeah, I mean, I think we're seeing them also come down market so far where they've never been before, where they're investing or potentially investing and purchasing companies that are below $100 million in revenue.
Yep.
So, all right, well, let's turn our attention to some of the other bubble signs that we're witnessing right now.
Yeah, the other things that we're seeing, call option volume. Option volume in general has been surging to new record highs, particularly with new exchanges that offer free options trading. But call option volume started reaching record highs last summer and now has just totally blown prior records out of the water. So that type of speculative behavior, that's just another mosaic in the sort of market bubble type picture. And the other thing we look at is the share of total option volume that is calls versus puts. And generally, when the share of option volume tilts towards calls, that shows very bullish behavior, exuberance. And right now, we're at the second highest call volume share in history. We're at about 64% of all options are calls, as opposed to puts, and that's the highest we've seen since the tech bubble in 2000s. So it's just another mosaic.
And what does that look like from a PE perspective?
Well, we're at the point now, if you look at the trailing price to earnings ratio on the S&P 500, so you take the current price divided by the last 12 months of earnings, the S&P hit 31 times the last 12 months of earnings during the month of January.
And what's that average? What's average?
Average is right around 20. So this is the most expensive, on that single metric, the most expensive U.S. equity market on record. One thing to keep in mind, we've never, we're looking at very depressed earnings from 2020 and prices that reflect a strong comeback in earnings in 2021. Right. So this will normalize somewhat. The forward PE ratio, where you take the current price versus the expectations for future earnings, is much lower. It's around 22 times. So there's that big disconnect there. But once again, nobody's saying this market is cheap in isolation. And this is just another point that it's certainly not cheap in isolation. It's not cheap relative to earnings, not cheap relative to sales. Really, these valuations are only justified by interest rates being extremely low and money supply growth being extremely high and money having to go somewhere. And the answer is not cash and bonds.
So we'll end with just for us to touch on this GameStop issue and what's going on there. And I'd be remiss to say it's sort of another bubble sign where this type of speculation and this type of behavior really is something that does show signs of a bubble. So just give the viewers, we're going to do a much deeper dive into this in a separate video, but give the viewers some perspective on what's going on there and what our expectations are.
Yeah, and so we won't get too in depth. Obviously, this has been very covered, and we're going to do a deeper dive on it. But at the end of the day, this is showing that at this point in some parts of the market, price just doesn't matter. It doesn't have any value. Well, there are so many nuances and layers to this onion that is the GameStop story. It's certainly going to be a film or at least a documentary.
For sure.
But at the end of the day, there is absolutely no fundamental justification for GameStop to be trading at these levels. And eventually it will come back to reality, and somebody's going to be caught holding the bag. And unfortunately, in these instances, particularly around market bubbles, it's usually the retail investor. And so, the final chapters of this story are yet to be written, but there is no fundamental reason for GameStop to be at these levels.
And we know some hedge funds have lost a lot of money, and some of these people who have been buying these options on GameStop have done very well and made quite a bit of money. So, but this is sort of graduated beyond a story about a company, and this is more about a movement and what's going on. So we're going to dig a lot deeper into that and talk about that in a separate video. But in terms of finishing up January, it's been an interesting month. Hopefully we'll get a little calmness going forward for the rest of the year, but we're off to the races right away. So thanks, Mike, for the update, and thanks for all our viewers, and we'll see you soon.
Thank you.